In 1870, a 31-year-old Ohio businessman named John D. Rockefeller founded Standard Oil of Ohio. Over the next 4 decades, he built the most powerful company in American history, controlling at its peak 90% of all oil refined in the United States. When the Supreme Court broke Standard Oil apart in 1911, it created 34 separate companies. 2 of the largest pieces, Standard Oil of New Jersey and Standard Oil of New York, would later merge in 1999 to form ExxonMobil.
156 years after Rockefeller's founding, the descendant of his empire remains the largest publicly traded oil and gas company in the world. In 2024, ExxonMobil made the largest American oil acquisition in 25 years, buying Pioneer Natural Resources for $60 billion. The bet that the Permian Basin of West Texas is the most valuable hydrocarbon resource on the planet, and ExxonMobil should own as much of it as possible.
I'm Hudson Thomas, this is Lana Chen, and you're listening to Charged Alpha, the S&P 500 Stock Encyclopedia, Episode 64. Today we go deep on ExxonMobil, ticker XOM.
From Standard Oil to the Pioneer Permian. Let's dig in.
Let's start with scale. $350.5 billion in trailing 12-month revenue. That makes ExxonMobil one of the 10 largest revenue-generating companies in the world, ahead of Apple, ahead of Amazon's product revenue, behind only Walmart and Saudi Aramco among non-financial companies.
The business is organized into 4 segments: upstream, exploration and production of oil and natural gas. This segment generates the majority of profits and includes ExxonMobil's prized Permian Basin position, the Guyana-Stabroek offshore development, and LNG projects in Papua New Guinea and Qatar. Energy products, refining crude oil into gasoline, diesel, jet fuel, and lubricants. Chemical products, converting hydrocarbons into plastics feedstocks and industrial chemicals. And specialty products, high-performance lubricants, synthetics, and waxes.
The why now for this episode is the Pioneer integration. ExxonMobil closed its $60 billion acquisition of Pioneer Natural Resources in May 2024, the largest U.S. oil deal in a generation. Pioneer brought 1.3 million acres in the Permian Basin, with production costs under $35 per barrel. That acquisition has now had 18 months to demonstrate results. The early verdict: synergies are arriving faster than projected. Permian production is exceeding the acquisition model, and the deal is looking like one of the better capital allocation decisions in the energy sector in years.
The macro context matters. Brent crude is trading in the $72 to $75 range in early 2026, amid uncertainty from U.S. tariff policy and OPEC Plus supply management. At $75, ExxonMobil generates enormous free cash flow. At $65, the math gets tighter. The commodity price is the key variable in every conversation about this stock.
Darren Woods has been CEO since January 2017, 9 years. He is 61 years old. He joined ExxonMobil straight out of college in 1992 as a chemical engineer, studied electrical engineering at Texas A&M, and got his MBA from Northwestern's Kellogg School.
Wood's career was built in ExxonMobil's refining and chemical businesses, the less glamorous, more operationally intense parts of the company. He spent time in Europe, running global refining before becoming CEO. He is known within the company as an engineer's engineer, process-driven, numbers-focused, skeptical of grand strategic narratives that can't be modeled in a spreadsheet.
The defining moment of his tenure is arguably 2020. When COVID hit and oil prices crashed, every major oil company cut its dividend. Shell slashed its dividend for the first time since World War II. BP cut it in half. Darren Woods refused to cut ExxonMobil's dividend. He told shareholders that the company's balance sheet and production assets could sustain the payout even at sub-$30 oil. It was an extraordinarily contrarian call. Analysts were nearly unanimous that ExxonMobil would have to follow its peers.
He was right. When oil prices recovered in 2021 and 2022, ExxonMobil shareholders had collected dividends throughout the downturn, while BP and Shell shareholders had seen their income cut. That decision, and the subsequent commodity boom, restored ExxonMobil to a position of financial strength it hadn't held since the pre-shale era.
The Pioneer acquisition is his second major bet. It was controversial at the time, $60 billion for an asset when oil was trading around $90 per barrel. Critics said he overpaid, that the timing was top of the cycle. The counter-argument: Pioneer's Permian acreage has multi-decade production potential at costs that don't require $90 oil. At $75 Brent, the assets are generating extraordinary returns.
The financials for ExxonMobil reflect a company that is highly profitable but inherently tied to commodity prices that it cannot control. Trailing 12-month revenue of $350.5 billion, actually down 3.8% year over year, primarily because oil prices are lower now than in 2023. But revenue is the wrong metric for an oil company.
What's the right metric?
Free cash flow. ExxonMobil generated $31.2 billion in free cash flow over the trailing 12 months. That's $31 billion available for dividends, buybacks, and investment, after paying for all operations and capital expenditures. For context, that free cash flow generation alone is larger than the total market cap of many S&P 500 companies.
The balance sheet?
Strong by energy industry standards. Total debt of $37.8 billion. Cash of $22.1 billion. Net debt to EBITDA of only 0.4 times, one of the lowest leverage ratios in the energy sector. This means the company has significant financial flexibility. It can continue buying back stock, sustain the dividend, and fund capital expenditures even if oil prices decline towards $65.
Shareholder returns.
This is the compelling element of the bull case at current prices. ExxonMobil paid $4 billion in dividends in 2025, a 3.5% yield at current prices. It repurchased $20 billion in stock in 2025 and has another $20 billion authorized through 2026. At the midpoint of oil prices, ExxonMobil is returning more cash to shareholders per year than any other energy company in the world. Financial health strong.
Analysts are moderately bullish on ExxonMobil. Of 32 analysts with formal ratings, 22 are buy, 8 are hold, and 2 are sell. Median price target of $125, 15.3% above current levels.
Goldman Sachs maintains a buy with a 132 target, calling the Pioneer integration tracking ahead of schedule with Permian production synergies arriving 18 months early. Morgan Stanley is overweight at 128. They highlighted Guyana's offshore assets as one of the highest quality upstream discoveries in a decade, with $25 per barrel break-even costs.
Barclays is overweight at 135, pointing to the $20 billion buyback and 3.5% dividend yield as providing shareholder return visibility that few energy companies can match at $70 oil.
Q4 2025 earnings, reported January 31st, were solid. Revenue of $88.2 billion beat estimates. EPS of $1.95 beat the $1.80 consensus. Full year 2025 earnings of $31.5 billion, free cash flow of $31.2 billion. Dividend raised 4% to 99 cents per quarter. The April 25th Q1 2026 report will be the first full quarterly test of the Pioneer integration at current oil prices.
The bull case for ExxonMobil is built on 3 pillars: the Pioneer asset quality, the Guyana option, and the capital return program.
Pioneer's Permian acreage is the first pillar. Exxon now holds approximately 1.5 million net acres in the Permian Basin, with estimated recoverable resources of 16 billion barrels of oil equivalent. The key number: break-even production costs of $30 to $35 per barrel. At $75 Brent, ExxonMobil makes $40 to $45 of margin per barrel from Permian production, before taxes. The cash flow from these assets is, in a commodity business, genuinely extraordinary.
The Guyana pillar is the second piece. ExxonMobil operates the Stabroek Block, one of the largest oil discoveries of the past decade. Current production is 650,000 barrels per day. 2 more floating production vessels are under construction, targeting 1.2 million barrels per day by 2027. Break even, under $25 per barrel. Guyana is, in industry terminology, a discovered and sanctioned resource with oil field costs that are among the lowest on the planet.
The capital return pillar is the third element. At $75 oil, ExxonMobil generates enough free cash flow to pay its dividend, complete its $20 billion buyback, fund its capex, and still have excess cash. That capital return program alone provides a 6 to 8% annualized return to shareholders before any stock price appreciation, which is a meaningful floor valuation argument.
The bear case starts with the thing that drives everything for an oil company: price. At $65 Brent, ExxonMobil's free cash flow drops to roughly $15 to $18 billion. The dividend gets covered, but the buyback pace slows. If oil falls to $55, which some economists assign a 20% probability in a tariff-driven recession, the math changes dramatically. The Pioneer acquisition at $60 billion looks less attractive in a world where oil is persistently below $60.
The energy transition is the second bear argument, and it's one that operates on a different timeline than quarterly earnings. The long-term trajectory for hydrocarbon demand is, in virtually every credible energy model, downward. Not this decade, and probably not next decade at ExxonMobil's scale of operation. But every major oil company is making a multi-decade bet that its core assets will remain economic. The Pioneer acquisition is a bet that Permian oil remains economic through at least 2040. That bet requires a view on energy demand that is inherently uncertain.
The third bear argument is execution on the Pioneer integration. $60 billion acquisitions have a history of disappointing. ExxonMobil's early results on synergies are positive, but the full integration, corporate culture, technology platforms, drilling programs, personnel, takes years to fully complete. Any material operational setback in the Permian would be scrutinized intensely. ExxonMobil versus three peers: Chevron, Shell, and BP.
Start with Chevron, ExxonMobil's closest U.S. peer. Chevron trades at 16.5 times earnings, modestly above ExxonMobil's 14 times. Revenue was down 2.2% year over year, similar to ExxonMobil's decline driven by lower oil prices. The Hess acquisition gives Chevron a growing Guyana position. ExxonMobil has the better Permian position and the lower cost structure post-Pioneer.
Shell is the European comparison. Shell trades at only 11.8 times earnings, a meaningful discount to both U.S. majors. This discount reflects pressure from European investors to transition faster from hydrocarbons, Shell's more aggressive commitments to LNG and renewables, and the general valuation gap between European and U.S.-listed energy companies. Shell's LNG trading business is the largest in the world and is a genuine moat asset.
BP is the most interesting peer right now because it's in the middle of a strategic reversal. Under previous CEO Bernard Looney, BP made aggressive pledges to reduce oil and gas production by 40% by 2030. New CEO Murray Auchincloss has walked back those pledges, recommitting to oil and gas investment. The result? BP trades at only 9.2 times earnings, either a deep value opportunity or a company with an unresolved strategic identity. ExxonMobil's consistency, same strategy, same capital allocation discipline, same management team, stands in stark contrast.
The options market is reflecting a muted risk environment for ExxonMobil. Put-to-call ratio at 0.91, nearly neutral. Implied volatility at the 35th percentile, below median, suggesting the energy sector at current oil prices is not generating unusual hedging demand.
Call concentration at 110 and 115 suggests traders are modestly positioned for recovery toward the year's highs. The meaningful put protection at 195 reflects concern that a global growth slowdown, the primary tariff risk scenario, could push oil below $65 per barrel and meaningfully compress ExxonMobil's earnings.
Insider activity is modest and unremarkable. One director made a $2 million open market purchase. 4 routine pre-planned executive sales totaling approximately $18 million. Net activity is consistent with normal compensation-driven selling, not any bearish view.
Darren Wood's compensation structure is heavily performance share-based, so the absence of large open market purchases from the CEO is normal and doesn't carry the same signal as it might in other industries. Woods holds approximately $45 million in company stock, a meaningful alignment with shareholders.
The near-term catalyst is April 25th, Q1 2026 earnings. Key questions. How is Pioneer integration tracking? Production volumes, cost synergies, capital efficiency? What is the current oil price assumption built into 2026 guidance? Has the buyback pace been maintained?
The structural watch points. First, Brent crude trajectory. If tariff uncertainty pushes the global economy toward recession, oil demand estimates for 2026 will be revised down, and Brent could fall below $70. Second, OPEC plus discipline. The cartel has been managing supply carefully, but internal tensions between members with different fiscal break-even needs create ongoing risk of a supply increase. Third, Guyana production ramp. Any delay in the next FPSO deliveries would push back the production timeline. Fourth, energy transition policy. Any U.S. policy shifts accelerating electric vehicle adoption or renewable energy deployment would affect long-term demand projections.
The financial metrics to track: Permian production volumes, Pioneer synergy realization versus schedule, free cash flow per barrel, and the pace of the buyback relative to authorization. ExxonMobil in 2026 is the definitive commodity plus quality investment in the S&P 500. Pioneer Natural Resources has added 1.5 million net Permian acres with break-even costs under $35 per barrel, transforming ExxonMobil's upstream cost structure. Guyana is producing at $25 break-even with significant expansion ahead. $31 billion in trailing free cash flow is being distributed to shareholders at an annual rate that provides 6 to 8% total return before any price appreciation.
The bull case says 14 times earnings is cheap for a company with the lowest cost production base in its history, Guyana optionality, and a buyback program that is mechanically supportive of the stock price. The bears who are right about the energy transition won't be right until 2030 at the earliest.
The bear case says oil price risk is real. The Pioneer acquisition cost $60 billion and still needs to fully prove its return, and a prolonged sub-$70 oil environment would compress earnings and free cash flow below what the current valuation implies.
The key variable is not inside ExxonMobil's control, the price of oil. If Brent stays in the 70 to 80 range through 2026, this is a compelling value proposition. If it falls to 65 and below on recession fears, the math changes. Everything else, the Pioneer integration, the Guyana ramp, the shareholder return program, is executing well. It's a commodity bet with world-class execution.
Nobel Prize-winning chemist Richard Smalley wrote, "Energy is the single most important challenge facing humanity today." He said that 25 years ago. Since then, humanity has burned more oil, gas, and coal than in all of prior human history combined. And the companies that have extracted, refined, and distributed that energy, for all the debate about what comes next, have powered every economic advance of the modern era.
ExxonMobil's bet that the Permian Basin and Guyana represent the best returning hydrocarbon assets on Earth, and that producing them with ever lower costs and ever better technology is the right strategy through at least 2040, is a bet about what humans will need for the next 15 years. The energy transition will happen, but it will happen on a timeline that rewards the lowest cost, most disciplined producers in the meantime.
That's going to do it for episode 64 of Charged Alpha, the S&P 500 stock encyclopedia. ExxonMobil, from Standard Oil in 1870 to the Pioneer acquisition and Guyana in 2026, 156 years of energy history, and still the largest publicly traded oil company in the world. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. Check it out. Until then, I'm Hudson Thomas.
And I'm Lana Chen. This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.